The housing market is constantly shifting, driven not just by mortgage rates and inventory, but by bigger forces like population trends, inflation, and long-term economic cycles. Today, I'm joined by seasoned real estate investor and friend of the podcast, Brian Burke, to explore what those macro and demographic shifts mean for investors and where the biggest opportunities might lie in 2025 and beyond. I'm Dave Meyer. Welcome to On the Market. Let's get into it. Brian Burke, welcome back to On the Market. Thanks for joining us.
Dave, it is great to be here once again. Thank you.
Good. Well, I just really want to check in with you. You are one of the more astute observers of the real estate market, of the economy. And since there's so much confusing stuff going on, I just like checking in with sophisticated and smart investors. And so now that I've, complimented you enough, I'd love to just hear a little bit about what you're thinking about the market. What's on the top of your mind?
There's all kinds of stuff going on in the market. But you know what? What actually is the market, Dave? I mean, there's like 100,000 different markets. You've got different sectors of real estate. You've got different geographies. You've got different strategies. There's always a strategy that works somewhere at some point in time. And that's really the trick to real estate investing, I think, is finding the right strategy in the right place at the right time, because everything is doing all kinds of different things. So we got a lot to talk about if we're going to cover the market today.
Yes, that's a very good point and well said, because you're totally right. There are seemingly always opportunities and you just need to find them. How are you working your way through all of the noise out there to sort of find the signal in the data and the news so that you can develop a cohesive strategy?
A lot of it is looking at kind of different sectors of real estate and where they're at in the market cycle and what kind of factors are involved in investing in them. We did a show recently about a small multifamily, and we talked about benefits of investing small. And it's kind of funny. I just this morning saw an article that came out talking about where the action really is. And guess where it was, Dave? It was in small multifamily.
There you go. Okay. So you got that one right. See, that's why I was calling you a smart investor. You got that one right.
Okay. There's one. I guess I'm 1 for 100. We'll call it that. But here's a great example. My core competency is in large multifamily. That's what I've been focused on for the last 20 years. And I just can't get behind it. It's almost literally uninvestable right now. When you think about how you make money in real estate, a lot of times people talk about the spread between the cap rate that you're buying at and the interest rate that you're financing at. And the difference between those two is where you make your money. And I'm not subscribing that I fully believe in that theory. I think there's a lot of errors and holes just in that belief. But assuming that that's the case, right now, multifamily cap rates are lower than borrowing costs, which means that you're losing money under that thesis. So trying to find a place to invest in real estate where you don't have the deck automatically stacked against you, that's the trick. And, can you buy single family homes and cash flow them with interest rates where they are today? Is that perhaps a strategy? Small multifamily, if you can find a really good deal because you found a tired landlord or somebody that needs to get out of the business, or a family that's inherited, properties that have been owned for dozens and dozens of years by the same owner who's done nothing to them to keep them up. There's a lot of places you can find needles in haystacks. But if you're looking at just broad strategy, multifamily is just one I really can't get behind right now. I think there's other places you can look.
So tell me a little bit more. You've been on the show before. You've talked a lot about just sort of a discrepancy between what sellers are asking for and what buyers are willing to pay. Is that the main underlying reason you don't like multifamily right now?
Yeah. Here's how I see this. Imagine that you live in a really small, dinky town. It's 100 miles to anywhere. There's no grocery stores in town. There's no access for food whatsoever, except for one restaurant. And their food is absolutely awful.
I've been to this town.
Yeah. Right. Yeah. So you're really hungry. What are you going to do? Despite the fact that you can't stand the taste, you're going to eat it. And that's what's happening in the multifamily market right now, I think, is you've got people that are eating that food because there's nothing else to eat. Now, you've got a few people that live in town who have a few extra pounds. And they're like, you know what? I can survive without food for a while. I'm just not eating. Until there's better food, I'm just not eating. And they'll live. But now here's what happens. Somebody else finally opens a competing restaurant, and then somebody else, and then somebody else. Now you've got 10 restaurants to choose from, and the business gets thinned out amongst all of them. And now nobody's making any money. All the restaurants are going, barely have any customers. And finally, one of them says, I'm going to make really good food because then everybody's going to come eat here. And they do that. And guess what happens? Everybody goes and eats. And eventually the other restaurants see that and go, we have to make better food. So they all start making better food. And when they do, people come. Even the people who are like, I'm not eating anything, they start to come. That's what the multifamily market is like. The prices are way out of scale and people are paying it because there's nothing else to eat. But as soon as you start seeing forced sales from lenders and owners who have loan maturities and all that, and all these properties start coming to market, they have to get legit on pricing or no one's going there and everybody's going to starve. So you're going to see pricing actually come in line with reality because that's what has to happen. That's kind of the market situation that we're stuck in right now. And it's coming. If you look at like loan maturities for this year, is approaching $1 trillion in commercial real estate. That's with a T. That's a lot. I don't even know how many zeros that is, but that's a lot of zeros. And that means that there's going to be things happening, I think, in the market that's going to change the dynamic a lot.
Yeah, absolutely. And I thought this would happen sooner. I'll just be honest. I thought that we would see more distress in this market sooner. Is it just people have gotten good at kicking the can down the road and now we're finally just at a point where, people are going to have to face reality because rates didn't go back down in the way that they had been hoping? Well,
I kind of think so, but not quite. So They were never good at kicking the can down the road. They were just doing it to survive. It wasn't doing it because this was good or this was like this particularly brilliant strategy. What was happening was lenders were like, oh my gosh, the market's terrible. If we foreclose or force a sale, we're going to take a huge loss. We don't want to report that loss to our investors and so on. So let's just give them another year. And then they give them another year and then the other year comes up and then it's like, okay, well, if we can get the borrower to give us $1 million principal pay down, then we'll give them another year and then they can kind of kick this can. But here's the part that I think a lot of people mistake is the lenders aren't doing this to help the borrower, the syndicate, or the syndicate's investors, or the owner's investors.
They're not doing it out of the kindness of their hearts.
Surprise, surprise. No, they're doing this to help themselves. And I'm telling you, the moment that things start to get to the point where the market's improving enough where the lender is assured that they're going to get all or most of their principal back, they're going to stop kicking that can down the road. And they don't care if that means that the borrower is going to lose 100% of their equity. As long as they get their principal back, that's the situation you're going to find yourself in. So it isn't a matter of like, oh, well, the lender's going to get tired of kicking the can or the borrowers are going to use up all their favors. This is simply just a matter of when the market gets good enough for the lenders are going to put their foot down.
That makes sense. And so it seems like you're choosing not to eat. You got a little extra fat using your analogy here. So you're choosing not to eat. When do you think the menu is going to look appealing to you? Do you have any idea of like estimates of when things might look a little better?
Yeah, well, my sayings that you've heard me say on this show before was end the dive in 25. So that means that I think that before prices can go up, they must first stop going down. So I think 2025 is the year that happens. Prices will probably stop going down, or at least real values will stop going down. There's a difference between prices and real values. Real values will stop coming down. My other saying is it's fixed in 26. And I think what that means is now that real values level off, seller expectations, maybe because they're under pressure, are going to align more with real values and allow transactions to take place. And then I've said investor heaven in 27, meaning this is the point where you're like right at the cusp of when the market's going to start to go back in our favor. So that's still my timetable for now. Now, I might have to come up with some new sayings if things don't go the way I think, but so far I think we're still on track for that.
No, I like your sayings. As long as they rhyme, I'm in on it.
Yeah, it doesn't matter if they actually happen.
But I actually think that the logic is sound here. We've also actually on the BiggerPockets Real Estate show, our sister show, been talking about sort of this sweet spot that Brian talked about where multifamily, maybe there is an opportunity in this 5 to 25-ish unit space. Tell us a little bit about why that subsection of the multifamily market is different.
Well, I think the primary reason is the seller profile. So if you look in the large multifamily space, your seller profile is a professional real estate investor or group, well capitalized, sophisticated. This is their business. This is their daily bread and butter. The market is fairly efficient because you got professional buyers who, are in this market every day. You get into the small multifamily space and your seller profile is just different. You've got mom and pops, you've got families, you've got individuals, you've got owner occupants in some cases, a whole different seller profile who isn't in this market every single day. And they're selling for their own personal reasons. There's death, divorce, changes in strategy, all the different things that come into play. And when those people, say it's time to sell, they're more inclined to do what they have to do to sell. Whereas your professional owner of a large property is like, oh, we think we should sell, but we've got enough capital. We've got access to capital to last longer. So don't sell now. You don't see that quite as much in the small multi-space.
And are you seeing volume here? Because I get in theory that this makes sense and that there's a good opportunity here. But so much of the problem these days is that even the things that logically make sense, there's just nothing out there to buy.
Yeah, that's true. And, I've given up on smaller properties a long time ago. So I'm not as into the market's inventory as I probably should be to answer that question really accurately. And I think it's going to vary from market to market. But here's the beauty of it is, in the small multi-space, you can actually stimulate deal flow. You can write letters, you can knock on doors, you can visit properties, you can call property managers, you can build relationships with management companies and see who their retired owners are. There's a lot of things you can do to drum up deal flow that doesn't really work as well in the large multifamily space. So if you can't find deals out there, go make a deal.
Okay. And do you have any advice on specific markets or things that people should be looking for? Because as you know, I selfishly am interested in this asset class or subsection of the asset class. Just any nuts and bolts advice on how people could go about this since you think there is opportunity? Yeah,
I think differently than when you're thinking about larger commercial properties and, people think about cap rate, yield on cost, IRR, all these different things. As a smaller investor who's trying to get started, think about cash flow and just think about what you buy these units for, what they rent for. If you were to improve them a little bit, what rent could you get? Subtracting out all the expenses and baking it down so that even at today's borrowing costs, you're making a positive cash flow. If you are able to do that, you're able to play the kind of time in market game versus the timing of market game, which I think works really well in this smaller space, especially if your timing is starting right now because you're getting in at a decent basis, much better than you would have, I think, if you would have been trying to do the same thing in, say, 2021 or 22.
So basically, just to reiterate, you're saying as long as you could sort of break even or hopefully do a little bit better, but as long as you're cash flowing, that allows you to get into the market and take advantage of any potential growth and upside. But you're protecting yourself and you're not at risk of losing an asset because, you're not actually cash flowing at all and you'd have to come out of pocket to make things work.
Yeah, and just make sure that you're really cash flowing. And this is where a lot of newer investors get tripped up is they think okay, this is going to cash flow at this price because rents are going to be this or expenses are going to be that. If you're unsure, always err to the side of caution and overestimate your expenses, underestimate your rent, anticipate capital improvements like resurfacing a parking lot or putting on a roof and things like that, and ensuring that you've got the capital to accomplish those things and you've got the cash flow to cover that type of stuff. Because what you don't want to find yourself in is a negative cash flow situation or a situation where you've got to pull extra money out of your pocket to try to keep the building maintained in a condition adequate enough to attract and retain tenants.
And that's true of residential too for everyone. You have to be calculating this correctly, regardless of whatever asset class you are looking at. Brian, though, you said something about a lower basis, which is honestly one of the two things that gets me excited about this potential asset class is, multifamily across the board down 10, 15, 20%, depending on the market. The other thing, though, is the way I see it is that rent growth is probably going to resume again at some point in the future after years of stagnating or, depending on who you ask, modest declines in rent on a national basis. Do you also agree?
I do. And you'll find some markets have had rent growth all throughout this period, like in the Midwestern markets where there hasn't been a lot of development. There's been moderate rent growth throughout this entire period of the decline in values, especially across the Sun Belt. But the primary factor behind rent declines, negative rent growth, and flat rents has been overactive development. And so that has been a headwind for probably the last 2 or 3 years, where multifamily new product deliveries have been at record highs. That's been making it difficult for owners of existing properties to have any pricing power because they're competing against brand new properties who are offering concessions like a month and a half, 2 months free rent and that sort of stuff. This is part of the, end the dive in 25 and fixed in 26 scenario is these deliveries are starting to trail off. It's extraordinarily expensive to build these properties. And with the financing and rent growth forecasts and all the other stuff, it's getting really difficult to borrow to build. And these new deliveries are trailing off, and that's going to create a supply and demand imbalance again and give pricing power back. So I think rent growth is going to make a comeback. I don't think it's going to be as soon as some people think. I know some people think it's going to happen right away. I think if we get second half of this year, we could see some at least flattening or leveling, maybe slight uptick in rents. By next year, I think we start to see a little bit more sustainable rent growth. And then I think by 27, it starts to get fairly robust.
Yeah, I'm totally with you. I've heard very ambitious people say 10% rent growth next year. I'm not there.
I'm not there.
I think we're, I just think that's so anomalous that it happens a few years in history. I wouldn't count on such a dramatic swing of the pendulum back in the other direction right now.
No, you saw that in 2020, right after COVID, but that was this unique unicorn where you had all these demographic movements into specific markets, and those markets had astronomical rent growth coupled with, COVID lockdowns that prevented construction in some markets and slowed down new unit deliveries and that sort of stuff. So those things are few and far between, but what happens to investors is it's so recent in your memory, you think, we could easily get back there. But I've been doing this for 35 years. I mean, I've seen that kind of rent growth once in 35 years.
Right, exactly.
So maybe sometime between now and 35 years from now, maybe we'll see it one more time.
Yeah. And honestly, it would be good if you own it, but something has to go wrong for those types of growth patterns to occur. Like you said, if it only happens 3% of the years you've been investing, Brian, something anomalous and weird is going on. And that usually comes with some trade-offs. It's not usually there's this huge anomaly and everything's wonderful. There's usually something potentially negative or just some trade-off that exists to create those really unique conditions.
Yeah, and it also sets you up for a reversal. And just as we saw after the 2021 rent growth, what happened after that? Mm-hmm. It fell off a cliff. And then, and that's kind of what happens. Things revert back to the mean, and the line on the graph gets too tall. It has to get back to the middle. And when it does that process is somewhat painful. So when you see that kind of rent growth, to me, that's not necessarily a sign to buy. It's more of a sign to sell.
Right. Yeah. Because you're getting that irrational exuberance, or you're peaking. Right.
Yes.
I totally agree. And I just think those past years are what, you would call a pull forward. You're basically taking all the rent growth from 4 years and pulling it into 1 year. And that's what we saw. We had 2 years of really amazing rent growth and then 3 years of really bad rent growth to compensate for that. Obviously, this should be self-evident to most people, but things just can't go up forever at these clips. It just does not make mathematical sense. And so, although I do think Brian's sort of thesis here is right. Get in a good basis, cash flow, break even, and then enjoy the benefits of time in the market. That totally makes sense to me. I just agree with Brian that don't count on that rent growth happening all at once. It's going to happen over the course of several years, most likely.
It will. And you'll have different things that are going on during that period of time that you may have to overcome. I mean, the one thing about this business is it's never easy. And, another little saying I've always had is there's always a good time to buy. There's always a good time to sell, but they never occur at the same time. And so, right now, is it a decent time to buy? Actually, I kind of think it's neither a good time to buy or sell. That does happen. At times. And I think, maybe next year after, it's going to be a good time to be a buyer. And then it's going to be a really good time to be an owner as you ride that wave. And then it's going to be a good time to be a seller right when everybody thinks it's a good time to buy. That's probably about the time that'll happen.
I assume, though, that that's your take on multifamily. Or are you looping in residential there for not being a good time to buy as well?
Not really. I think residential operates on a whole different plane. There's not a run on residential construction in a lot of markets. Now, there are some markets where you're getting like these massive buy to rent subdivision projects that are coming on and, they're building hundreds, maybe even thousands of homes as rentals. And that is occurring in some isolated markets, but it's not widespread. So I think you've got a different dynamic there. You also remember who is your end buyer, to get you out of that investment is somebody that isn't buying it because of the cap rate. They're buying it because they like the way the kitchen flows to the dining room and it's in the neighborhood close to their school. And, those reasons give you a lot of liquidity and a pretty easy exit that you don't have in a lot of multifamily investments. So, but again, it still boils down to the same thing. You've got to be able to calculate it out to cash flow. If you're buying something that's a negative cash flow, that's not really investing, in my opinion. It's speculating, and that's a whole different animal.
Brian, tell me a little bit about how you view, I know this isn't your bread and butter anymore, but like how you view the prospects of residential investing right now.
Yeah, so this one is like really highly micro specific. In other words, you can go almost street to street across the country and have different real estate market conditions in the single family space. School district makes a big difference. Crime rates make a big difference. All sorts of different things are going to play a role. I had a goal when I was in my, I think, late 20s that I said, you know what, I'm going to buckle down and I'm going to buy one rental house a year. That's going to be my goal. And I never accomplished it, but I accomplished way more than that, when I set that goal. But I think if anybody did that and accomplished it, timing does matter a little bit, but no matter what market you're in, you're going to do way better in your later years in life than probably 95% of the population. It is one of the greatest wealth builders, and really just getting started is the primary thing. You've got to just get started and just set a goal and start after it. Now, time in the market is a big deal, especially in the single family space. And for smaller investors who are just accumulating a small rental portfolio, you don't get rich off of collecting rents on a 3-bedroom, 2-bath house, even if you have 10 of them. But you will get very wealthy over time here. So time in the market really does matter. But timing also does matter. If you bought a bunch of rental houses in 2005, you were hating life in 2009, and you might have even been in bankruptcy court. You certainly had foreclosures. It was just an absolute bloodbath. But I don't think that now is a repeat of that time. We've seen a big decline in commercial real estate, but we haven't seen that decline in residential. And I don't think that means that a decline is right around the corner. What I don't see is a 2008 style kind of like residential real estate collapse. That was a specific situation that was tied to crazy lending standards and, just runaway enthusiasm in the residential market that all came collapsing in a ball of flames. And we don't have those same conditions being set up right now for that space. And I don't think that this is a bad time if you're concerned about timing the market.
Yeah, actually, I just did a deep dive into mortgage delinquency rates and what's going on with credit standards in residential versus commercial, because I don't know how much you're on social media, Brian, but there's been a lot of hubbub about delinquency rates over the last couple of weeks. So if you want to understand what Brian's saying and why credit conditions are very different. If you haven't yet, go check out the April 3rd episode of On the Market. But Brian, I agree with you. I think like for the market to truly crash, you need to have delinquencies, you need to have forced selling. There's just no evidence of that right now. By almost every standard, the American homeowner is paying their mortgages and they are in a relatively good position to continue servicing their debt. So that's all on the good side. That said, I do see prices softening. We are seeing inventory pick up. And so you're saying it's a good time. I actually kind of think we're in a nice window here, potentially. But what advice would you give to people who want to avoid the quote unquote catching the falling knife scenario where, you buy in a market, it drops 1 or 2%. Like, is that something you should really be concerned about? And if so, is there a way to mitigate that? Or how do you wrap your head around that?
Yeah, 1 or 2% is not a falling knife. Commercial real estate has fallen like 40%. Everybody says 20 because cap rates have decompressed by 20%, but they forget that the income also declined. Yep. And when you factor that in, commercial real estate's down like 30 to 40%. That's a falling knife. Single family homes coming down 1 or 2% is a falling fork. I mean, you could literally put your toe under it and it's not even going to hurt you if you have a shoe on. So, put a shoe on and go invest in some single family homes. How do you do that? Well, don't get 100% financing with negative amortization, floating rate interest loan.
Right.
Go get like a 20% down conventional landlord financing with an amortizing loan with a 30-year maturity. So nobody can tell you have to sell. This is a part of the problem with commercial too, is like these loans in commercial come with a maturity date. So whatever that maturity date is, you have to do something by that date, whether you have to refinance or you have to sell. And if that happens at a time when times are bad, you have a major problem. But in single family, you have this beautiful financing package called the 30-year fully amortizing loan. And what that means is no one can ever tell you you have to sell right now unless you can't afford to make the payment. And as long as you have enough room in the difference between the payment and the income, you shouldn't find yourself in that position, especially if you have some cash reserves. So have cash reserves, finance conservatively, use fully amortizing debt, not short-term debt, and you will be totally fine if the market comes down 2 or 3%. It's going to take a while and you have to be patient. I mean, I did this. I bought a house in 1990. And from 1990 to 1997, the price was literally the same.
Yep.
I mean, 7 years, it didn't go up at all. And that happens sometimes. But guess what? By like 2001, the price had doubled.
Yep.
So that is my time in market theory. Use the time when prices are slacking a little or kind of when price activity is calm. Use that period to acquire your assets. Don't be acquiring those assets when it's like, hey, everybody, we got to go buy houses because this is the time to buy. And everybody I know is buying. And then prices are running up and you're like, this is great. And it's like, no, this is terrible. You want to be buying in times like this when things are kind of at slack.
Yeah, when the mainstream media or the average person thinks it's a good time to buy real estate, it's too late. You missed the best buying window already. And that's not to say that you shouldn't be careful, as Brian said. Like, there are things that you should do, and you should not just go out and buy anything. But this actually is, I think, a reasonable time to buy. And I haven't been doing this as long as you, Brian, but I've been doing this for 15 years now. And I tell people that I got started in 2010 and people are always so jealous. They're like, oh my God, what a great time to buy. And, in retrospect, it was, but my property value went down for 2 years after I bought that property, that it wasn't like instantly a success. And now I look like a genius, but you have to take a little bit of a risk and have to just give yourself that time to hold on to these properties. And so completely agree what you have to say here, Brian. So we've covered a lot. We've covered commercial multifamily or smaller multifamily. We've covered residential. Brian, tell me just a little bit with all the stuff. You just said DOGE, you talked about tariffs, you talked about the risk of a recession. What are some of the, main indicators, 1 or 2 things that you're going to be watching? It is the first day of the second quarter. Over, let's say, Q2 here, what are the main things you're going to be keeping an eye on?
I'm watching for recessionary indicators like, new jobs, jobless claims, the consumer price index, those kinds of things, because That seems to be what's on the mind of the Fed when they're setting interest rate policy. And I think that there's a complete disconnect right now between what's happening in the real world and what's happening behind the boardroom doors in the Fed when they're setting interest rate policy. And so, rather than paying attention to what they should be paying attention to, I'm paying attention to what they are paying attention to. And I think when you start to see some of these things, like, recession is getting more evident and, there's more jobless claims, fewer new jobs, then you might start to see some interest rate declines. And that's going to mean that there's going to be some opportunity to acquire again. If we don't see that and we continue to see like this robustness where no matter how bad you think the economy should be, it's still not bad at all, then I think it's going to be bad for buying assets for a while. It's going to take a long time for this to catch up. And so I'm trying to monitor those things, even though I feel like they should be kind of irrelevant. They've become very relevant. And I think you have to pay attention to it.
All right. Well, Brian, thank you so much for joining us. This was a lot of fun as usual. We appreciate you being here.
It's my pleasure. Anytime.
And thank you all so much for listening to this episode of On the Market. For BiggerPockets, I'm Dave Meyer, and we'll see you next time.